There, welcome to another edition of Coffee Talk. I'm Brent Kirkendall. This is John Kirkendall. We're with Gulf Coast Financial Services, and each month we come and take a short time just to kind of bring you updates on what's happening in the market, things that are going on in our economy. Hard to believe it's already June and we're in the middle of summer. Yeah. And we've gone through some months of quarantine and social distancing, but the economy is open and things are continuing to open up, and we're seeing businesses begin to bring back employees, and we're seeing those numbers of unemployment begin to decrease slightly, and hopefully it'll continue to get better as we move forward.
Yeah, I think, Brent, we've seen every week the unemployment numbers have gone down. Just released the employment numbers for May, and that was actually up. So things are looking really good in the economy. The stock market is doing really well right now. And there's a lot of positive things going on. But this morning I wanted to talk about two things that kind of have gotten overlooked with this whole COVID-19 social distancing, quarantine.
Absolutely.
And how it has reacted.
Well, you know, we've talked about these in previous coffee talks, and just some confusion. There were two acts that actually came out, one at the very beginning of the year, and then one shortly after we found out about the coronavirus and COVID-19. And so we wanted to do a little bit of clarifying today on some of the differences in those and make sure everybody understood the differences between the Secure Act and the CARES Act.
Right. Well, you know, the Secure Act was really about retirement.
Right.
And that was kind of thrown on us January 1st, and we really weren't ready for it. But what it did was, the two major things is that it extended the required minimum distribution, which you mandatorily have to take out of your IRA or 401k or retirement account. It extended it from 70 to 72. And then also, the big thing was it eliminated the stretch IRA, so that if I passed away and I left you my IRA, then you would be able to take that over your actuarial life.
On the old way.
On the old way.
Right.
Now, under the Secure Act, we have to take that out over 10 years. And so there's some planning that needs to be done there, and people need to be aware of this, and certain trusts need to be reviewed. So we need to make sure that people understand how that reacts.
Absolutely. It can create a significant tax situation for people if you're having to take out a sizable amount of qualified money over a 10-year span versus a lifetime. And so you need to be looking ahead at that. Now, one thing about RMDs, or required minimum distributions, I know the number went up from 70 and a half to 72, but my understanding is they don't have to take one this year anyway, correct?
Well, that goes under the CARES Act, which...
This is where confusion comes in.
which was actually passed in January, the end of January, 1st February, which was the stimulus package. Right. And in that, there were several things that were used to kind of stimulate the economy. You should have received a stimulus check, $1,200 per individual, $500 per child under age 18 in the household. And that was also discounted for income. So some people didn't get the full amount, but everybody should have gotten a check by now.
Right.
Secondly, it waived the 10% penalty if you took money out of your IRA or 401k prior to 59 and a half. Under the old regs, or the regs that will be after this year, there's a 10% penalty imposed if you take money prematurely out of your account. Now, that is waived this year as long as it's a COVID event. Right. You had COVID-19, your spouse had it, or you were impacted because of the social distancing and the impound that we had.
Right.
So also with that, we did waive your RMDs for 2020. So if you don't need to take money out of your IRA this year or 401k to live on, then you need to not do that, because you can save money on those taxes. Or what you need to do is talk to your advisor, because there may be a way we can pull that out, go ahead and pay the taxes on that money, and then put it into a Roth IRA where it grows tax-free.
I mean, we've talked a lot about taxes being probably the lowest they're going to be for quite a while. So your tax brackets are even though none of us like to pay taxes, we have to, but tax brackets are low relatively, and so we may not see this again for a long time.
Well, you know, the thing about it is we're looking at over a $3 billion stimulus package. That they've done so far. They may do more.
Right.
So somehow that money has to be paid back. So our debt continues to increase. And if you look at the debt clock, you can see how it is increasing. And so eventually that money's going to have to be paid back. So yes, I do believe that taxes are probably the lowest they'll ever be in history. And we need to do what we can do now to pay taxes at a lower rate and then let our money grow tax-free for us. Also on that CARES Act, it increased the charitable amount that you can deduct. So that has increased. You need to talk to your tax specialist about that. Let them review your taxes and see how that's going to impact you. You may want to do more charitable contributions this year and be able to take a part of that deduction, because everything reverts back next year.
Absolutely.
January 1st, we go back to the RMDs, the required minimum distributions. We go back to the lower charitable thing. Everything's back to square one
Right.
after we get past this year. And finally, the student loans can be deferred up until September. If you have a student loan, you can defer the interest and the payment until September if you qualify. So
Yeah, I mean, there's a lot of things that are built into both of these, and they can be confusing if you try to lump them in or think about, just like talking about required minimum distributions can deal with both acts.
Right.
And so there are things that overlap, and we need to be aware of those and make sure that everybody's aware of those. I will say this, that we were, if you haven't received a stimulus check and you think you're due one, go to the IRS website and type in CARES Act, stimulus package, whatever, and it will direct you to that. You can actually type in your information. You'll need some of your tax return information if you haven't filed for 2019 yet, because the due date is not till the middle of July.
July 15th.
Then you'll have to use last year's taxes, but you use those adjusted gross income numbers, and they'll actually go through that process with you, and you can see if you qualify for that. I know that we were talking, you had received yours and I hadn't received mine. And so I actually went online and looked at it and filled out the information, and they're very thorough about telling you your check will go out on this date and you'll be able to follow that and see if you qualify for that. So don't just assume because nothing's been deposited into your bank account or you haven't received a check in the mail that you're not going to get one or you didn't qualify. So if you feel that you do, please go online and figure that out.
You know, and kind of wrapping this up, Brent, I want to tell everybody out there that there are some significant tax planning events that happen because of these acts. And we need to be aware of those. And you need to talk to your tax specialist. You need to talk to your financial advisor. You need to get your retirement plan or income plan updated and be able to take advantage of these acts. We never want to give the government more than they're due. We want to give them what they're due. And so we need to be proactive in our tax planning. And also, don't forget, July 15th, you have to file your taxes and pay your money. So
yeah, I think it's a key thing, not just tax planning, but retirement planning, estate planning. We need to be proactive in all of that, making sure that we have all our ducks in a row, so to speak.
Yeah.
And as we tell our clients all the time when we talk to them, this is a plan is a kind of a living, breathing thing. It changes all the time. And so just because you did it 15 years ago, it doesn't mean it's set it and forget it. And so our life events change, our things happen, and so we need to update those. So just kind of a mental check to be aware as you're getting ready to finalize taxes or whatever for this year, that you go in, check those things out, and see if there's some ways where you can do some tax planning. Make sure your estate planning's in line. Make sure your retirement planning's in line as well.
Well, it's amazing how many people they might do something. And then they react after it's done.
Correct.
And so that tax planning is really important. It's a progressive tax, as we say.
Absolutely.
So the more you make, the more you pay. And you need to be able to defer what you can, and that's what we're here for.
Absolutely.
That's what we like to do.
And so if you have any questions, whether you're a client or not, or you just want to talk, or we can review something for you, we are here. We're, as we say, we've been here. We didn't go away. Our doors are back open, obviously, as most of the economy is opening back up in the state of Florida. And so if you have any questions or concerns, please give us a call. You don't have to come in if you're still conscientious about those things. We can definitely speak to you via email or over the phone, or we can set up a Zoom meeting and video chat with you. But we want to be able to keep our community well informed and those that we deal with about what's going on and the latest of those things. If you do have any questions, give us a call. It's always a pleasure to see you and talk to you. And we hope that you have a great day and a great month of June. Hard to believe summer's here.
Right.
Have a good one. We'll talk to you later.
So you.